Hello dear traders, let us review which economic events drove the markets in past week. The S&P 500 stock market index ended last week 0.07% lower while posting a record intraday high. Investors were focused on quarterly corporate reports but were reluctant to take more risks. Stock market volatility remained minimal for the second week in a row. At the same time, the decline in the US dollar index last week was the biggest in the past 3 months. The expected second quarter S&P 500 earnings decline stood at 3.7% on Monday. It improved to minus 2.8% on Thursday on the back of positive earnings reports from Apple, Alphabet and Amazon. However, the consensus forecast reverted to initial minus 3.7% after weak reports from Chevron and Exxon, as well as the fast food chain McDonald's on Friday. In essence, a very narrow trading range for the US stocks was formed on quarterly corporate earnings expectations. The US dollar index had been falling last week. In the beginning of the week, the dollar weakened ahead of the policy meetings of the Federal Reserve and the Bank of Japan. The Federal Reserve meeting concluded on Wednesday. Investors anticipated the expansion of the stimulus program by the Japanese central bank, which falls short of market expectation, and they were right. The additional monetary stimulus measures by the Bank of Japan were much smaller than expected, which contributed to yen strengthening against the dollar. At the same time, the Federal Reserve left the interest rates unchanged and didn't say anything substantial about future plans. Therefore, investors focused on negative macroeconomic statistics, which contributed to weakening of the US dollar. Durable goods orders fell 4% in June, declining for 2 months in a row. It was the biggest fall this year. Besides that, the existing home sales grew much less than expected. No particularly important data came out on Thursday. Weak second quarter GDP data were released on Friday, which disappointed investors. The US economy grew just 1.2% instead of an expected 2.6%. It substantially lowered the likelihood of a rate hike by Federal Reserve, pushing the dollar lower. US stocks rose against this background as companies benefit from lower interest rates and weaker currency. The main event this week is the release of jobs data for July, which is scheduled on Friday. In our opinion, the tentative outlook is negative. It should be noted that the S&P 500 is trading in a narrow range just 1% wide. Last time such dynamics was recorded in mid-1970s. Theoretically, a period of extremely low volatility may end in a strong rally to new highs. This was all for the main events of the past week. Happy trading and see you next week.